there, and welcome to the Property Wealth Podcast.
It's great to have you with us today.
Yeah, today we're diving into something that's super important for real estate investors: estate planning.
Absolutely, Sarah. It can feel a bit daunting, but it's so crucial for building and protecting your wealth for the long term.
Right? You've worked hard for your investments, and having a solid estate plan ensures that your assets go where you want them to when the time comes.
Exactly. We'll talk about practical steps you can take, common pitfalls to avoid, and how to make sure your loved ones are taken care of.
And we'll also cover things like trusts, wills, and how to make your real estate work for you even after you're gone.
Yeah, and we'll share some real-life examples too, which I think will help make it all a bit clearer.
So whether you're just starting out or you've been in the game for a while, this episode is packed with insights that'll help you secure your legacy.
Let's get into it then.
Perfect. So Mike, let's start with the basics. What do you think is the first thing a real estate investor should consider when it comes to estate planning?
You know, Sarah, when we talk about estate planning, it's really about securing your legacy, right? Especially for folks over 40. I mean, at this stage in life, many people are starting to think more seriously about what happens to their assets down the road.
Exactly, Mike. It's like they're at a crossroads, looking at retirement timelines, and wondering how to ensure their hard work pays off for their families.
Right. And inflation is a big concern these days, too. Just think about it. Many people are seeing their savings erode, and property can be a solid hedge against that. Real estate tends to appreciate over time, which can help preserve that wealth.
Absolutely. I remember chatting with an investor named Jane, who's in her late 50s. She had a few rental properties and was worried about how inflation might impact her retirement plans. She realized that without a solid estate plan, her kids might end up losing out if something happened to her.
That's a great point. It's not just about the properties themselves. It's about how they're structured and who gets what. I mean, if you don't have a plan, your heirs could face a real mess.
Right, and emotions can run high in those situations. I've seen families torn apart because of misunderstandings or lack of communication. Like, if Jane didn't have a will or a plan, her kids could end up fighting over those properties instead of coming together to honor her memory.
Exactly, and that emotional side can be just as important as the financial side. You want your family to remember you positively, not just as someone who left them a headache.
And with market shifts happening all the time, it's crucial to be proactive. I mean, look at the changes in the housing market over the past few years. It's been a whirlwind. One minute you're up, the next you're down. Having a plan can help navigate those uncertainties.
Yes, and that's where estate planning comes in. It can help you manage those shifts and protect your family from potential losses. For instance, I knew a couple, Tom and Lisa, who purchased a property right before a market downturn. They had a solid estate plan in place, and it allowed their kids to hold on to the property until the market recovered.
Smart move on their part. It's like they were thinking long term.
Exactly. They understood that real estate is often a long game. They didn't panic. Instead, they had a strategy that allowed their family to benefit in the long run.
And that's a lesson for everyone. With the current economic trends, it's essential to think beyond just the immediate future. You have to consider how your investments will stand the test of time.
For sure. And let's not forget about wealth transfer. It's not just about leaving money behind. It's about passing down financial literacy and the ability to maintain that wealth. People over 40 are often in a position to teach their kids about investing and property management.
Yeah, I think that's such a critical part of the conversation. If you've built something substantial, you want your children to understand its value and how to manage it, rather than just handing them a bunch of properties with no guidance.
Absolutely. I mean, one of my clients, an investor named Mark, did just that. He started involving his kids in some of his investment decisions, teaching them how to analyze properties, and even letting them help manage one of his rentals.
That's amazing. It's like he's giving them a head start in life.
Exactly. And when it comes to estate planning, that knowledge becomes invaluable. If something were to happen to him, his kids wouldn't just inherit properties. They'd inherit the skills to manage them effectively.
I love that idea. It's such a holistic approach to wealth building. It's not just about the monetary side. It's about fostering responsibility and understanding.
Right. And, for people over 40, the clock is ticking. Retirement isn't that far away, and having a solid estate plan becomes even more crucial as you get closer to that stage.
It really does. And with the rising cost of living and uncertainty in the job market, having real estate as part of your portfolio can provide that financial security.
Definitely. It's like a safety net. You know, I've seen investors who've worked hard all their lives, and because they had a plan, they were able to retire comfortably and leave a legacy.
And that's what it's all about, isn't it? Creating a future where you're not just secure, but your family is too.
Exactly. And once you have that peace of mind, you can focus on enjoying life rather than stressing over what might happen to your estate.
So it seems like the next step is to dive into some core strategies for effective estate planning.
Absolutely. Let's explore some practical ways to set yourself up for success. So, Sarah, when it comes to estate planning for real estate investors, I think it's really helpful to start with a few core strategies, right?
Absolutely. It's like laying a solid foundation before you build your wealth. What's the first one you'd recommend?
One of the key strategies is the asterisk 1% rule. Names. This is a great guideline for evaluating rental properties. Basically, if the monthly rent is at least 1% of the purchase price, that's a good sign.
Right. So if you buy a property for $200,000, you should aim for at least $2,000 in rent each month?
Exactly. It helps you quickly assess whether a property is worth considering. But, of course, it's just a starting point. You still need to dig deeper into the numbers, like operating expenses and financing costs.
Yeah, and that's where the asterisk 50% rule times asterisk comes in, right?
Yes! The 50% rule says to estimate that about 50% of your rental income will go towards expenses. So, using our previous example of $2,000 in rent, you'd expect to spend about $1,000 on expenses.
That's a smart way to budget, for sure. It gives you a clearer picture of your cash flow.
Exactly, and speaking of cash flow, understanding asterisk cap rates, asterisk is essential too. The capitalization rate is a measure of a property's profitability. You calculate it by dividing the net operating income by the property value.
So if a property generates $20,000 in net operating income and is worth $200,000, the cap rate would be
10%, which is pretty solid. A higher cap rate usually indicates a better return on investment, but you have to consider the risk involved as well.
That makes sense. And when you're evaluating properties, having a asterisk checklist asterisk can really help streamline the process. What would you include in a deal evaluation checklist?
Great question. First, I'd look at the property location. What's the neighborhood like? Then I'd assess the condition of the property itself. Are there major repairs needed?
And what about the financials?
Definitely, you want to review the potential rental income, the purchase price, and all those expenses we talked about earlier. Plus, you should consider financing options too.
Right. There are so many choices, from traditional mortgages to hard money loans.
Exactly. And it's important to know what works best for your situation. For instance, a traditional mortgage might offer lower interest rates and longer terms, while hard money loans can be quicker to secure for a flip or renovation project.
So it really depends on your strategy and timeline.
Precisely. Now let's not forget about the types of properties. Single-family homes, multifamily units, and commercial properties all come with different advantages and challenges.
Can you break that down a bit?
Sure. Single-family homes can be easier to manage and finance, making them great for new investors. Multifamily units, on the other hand, can provide more cash flow but require more management skills and can have higher turnover rates.
And commercial properties are a whole different ballgame, right?
Yes, they can be lucrative, but they often come with longer lease terms and can be affected more by economic downturns. Plus, there's usually a steeper learning curve involved.
It sounds like a lot of factors to weigh.
It is, and that's why having a clear strategy and sticking to your investment goals is crucial.
So what are some common financing options for investors?
Well, aside from traditional loans, there are also lines of credit, seller financing, and even crowdfunding platforms. Each option has its pros and cons.
Like seller financing, where the property owner helps you finance the purchase directly, right?
Exactly. That can be a great way to bypass some of the traditional lending hurdles. And with crowdfunding, you can pool resources with other investors to buy larger properties.
I love that idea. It opens up so many possibilities for people who might not have enough capital on their own.
Absolutely. But remember, whatever financing route you choose, you need to factor in the costs and ensure it aligns with your overall strategy.
And don't forget about taxes.
Right. Understanding tax implications is a must. You want to be aware of how property taxes, capital gains, and even depreciation can affect your bottom line.
It's like a puzzle, isn't it? You have to put all these pieces together to see the full picture.
Exactly, and that's why it's so important to stay organized and keep track of all your investments.
So, Mike, it sounds like we've covered quite a bit of ground here, but there are definitely some common pitfalls to avoid when it comes to estate planning and investing.
Yes, and those pitfalls can be costly if you're not careful. Let's dive into those next. You know, Sarah, one of the biggest mistakes I see investors make is over-leveraging. It's tempting to think that the more you borrow, the more you can grow your portfolio, right?
Absolutely. It feels like a shortcut to wealth. But what happens when the market shifts, or even when interest rates go up a little?
Exactly. I had a client a few years back who bought 2 properties back-to-back, both with high loans. He thought he could manage the cash flow easily, but a couple of months later, he lost his job. Suddenly, both properties were a burden instead of an asset.
Oh no, that sounds stressful. So he was stuck with those mortgage payments even though his income dried up?
Right. And he didn't factor in the costs of maintenance and repairs on top of those payments. It's crucial to have a cushion, you know? A good rule of thumb is to avoid borrowing more than, say, 70% of the property's value. That way, you maintain some breathing room.
That makes a lot of sense, and I guess bad tenants can really complicate that situation too.
For sure. I mean, it's one thing to buy a property, but it's another to find the right tenants. I had a friend who was a first-time landlord. He went with the first couple who applied, thinking they seemed nice enough.
And?
Well, they paid the first month's rent then. They just stopped. Turned out they were in a tough financial spot, and he ended up going through an eviction process. It took months. And in the meantime, he had to cover the mortgage and maintenance costs.
That sounds like a nightmare.
Yeah, and the hidden costs can really add up too. Many investors overlook things like property management fees, maintenance reserves, or even unexpected repairs.
Right. I think some people forget that properties aren't just cash cows. They need upkeep.
Exactly. I mean, you might buy a property thinking it's a great deal, but then you find out the roof needs replacing or the plumbing is shot. Those costs can wipe out any profit if you're not careful.
So how can someone spot those red flags early on?
Great question. Always do a thorough inspection before buying. Look for signs of wear and tear. Check for things like mold, outdated systems, or even pest issues. And, talk to neighbors. They can give you insight into the property and the area.
That's smart. I guess it's also about doing your due diligence on tenants, right?
Absolutely. Check references and credit scores, and if you can, meet them in person. Trust your gut. If something feels off, it probably is.
I can see how that would help avoid future headaches. What about the cash flow aspect?
Cash flow. Another pitfall. Many investors get so excited about the potential appreciation of a property that they forget to check if it'll actually cash flow positively each month.
So, they might buy a property that's in a trendy neighborhood, thinking it'll go up in value. But if the rent doesn't cover the mortgage and expenses...
Exactly! I had a client who bought a condo in what was supposed to be the next hot market. But, it was overpriced. The rent barely covered the mortgage. And after a year, it wasn't appreciating like they thought. They were stuck.
That sounds frustrating. What do you recommend to avoid that scenario?
Always do a cash flow analysis before you buy. Look at the potential rent against all expenses, including management fees, taxes, and maintenance. If the numbers don't work, walk away.
Wise words. And then there's timing the market, right?
Yeah, that's a tricky one. I mean, it's natural to want to buy low and sell high, but trying to time the market can lead to missed opportunities. I had an investor who waited for the perfect moment to buy. And by the time they finally jumped in, property prices had already risen significantly.
So basically, waiting can cost you more in the long run?
Exactly. The best time to invest is when you're financially ready, not when you think the market is at its lowest. Focus on your strategy and long-term goals instead.
That's a great perspective. And I think people can feel overwhelmed with all these factors. Where do they even start?
Well, I'd say start with education. Read books, listen to podcasts, and connect with other investors. And don't rush in. Take your time to build your knowledge and confidence.
And maybe even consider working with a mentor or advisor?
Absolutely. Having someone experienced on your side can make a huge difference. They can help you navigate those early pitfalls and keep you accountable.
So it sounds like the key is preparation and awareness, right?
For sure. And if you do make mistakes, don't let them derail you. Learn from them and adjust your strategy moving forward. Real estate investing is a journey. It's about building wealth over time.
Well said. It sounds like a balance of being optimistic, but also realistic about the challenges.
Exactly. And remember, every investor faces challenges. It's how you respond that makes the difference.
That's a positive note to end on. So what's the next step for someone looking to dive into real estate investing?
Well, I'd suggest starting small. Maybe look for a single-family rental or a small multifamily unit. Get your feet wet, learn the ropes, and build your confidence from there.
Great advice. I think that's a solid plan.
All right, so let's dive into some actionable steps for estate planning, especially if you're a real estate investor.
Yeah, because it can feel overwhelming sometimes, right? But starting small can make a big difference.
Exactly. So first off, I'd recommend sitting down and actually writing out your goals, what you want for your estate. Doesn't have to be perfect. Just get your thoughts down on paper.
That makes sense. It's like having a roadmap, right?
Absolutely. And once you have that, you can look into some useful tools. For example, you might want to check out an app like Zillow or Redfin. They can help you get a good sense of property values in your area, which is crucial for estate planning.
Right. And then there's BiggerPockets, which has such a wealth of information.
For sure. They have calculators that can help you analyze potential deals and understand cash flow. Really valuable for making informed decisions.
Speaking of analysis, what about tools like DealCheck or Rentometer?
Great point. DealCheck is fantastic for evaluating multifamily properties, and Rentometer can give you a quick look at rental rates in your area.
So many options. And for those just starting, joining a local real estate investment group or meetup can be super helpful too.
Definitely. Networking is key. You can learn from others, experiences, and maybe even find a mentor.
That sounds encouraging. And what about books? Any recommendations?
Yes! The book on managing rental properties by Brandon Turner is a great one. It covers not just management, but also some estate planning concepts.
And I'd add Estate Planning for Dummies. It's user-friendly and breaks down complex topics into manageable chunks.
That's a solid choice. Also, consider listening to podcasts focused on real estate investing. They can provide insights while you're on the go.
Totally. You can get inspired while you're doing chores or driving. It makes it easier to fit learning into a busy life.
And don't forget about creating a habit of analyzing at least one deal each week.
That's a manageable goal. Just one deal a week can help you build confidence over time.
Exactly. And as you get more comfortable, you can expand that habit. Maybe start exploring new markets or types of properties.
And remember to revisit your estate plan regularly. Life changes, right? So your plan should too.
Great point. Keeping your plan updated ensures it reflects your current goals and circumstances.
And what about using local MLS access?
Yes, if you can get access to your local multiple listing service, it can be a goldmine for property data.
So much information at your fingertips.
Right. And don't be afraid to reach out to a real estate attorney to discuss your estate planning options. It's a worthwhile investment.
For sure. Getting that professional guidance can really help clarify things.
And remember, start where you are. You don't need to have everything figured out. Just take those first steps.
Exactly. So those are some practical first steps. Now let's bring this all together.
So as we wrap up this episode, let's quickly recap a few key takeaways about estate planning for real estate investors.
Absolutely. First off, it's really important to have a solid estate plan in place, right? It helps protect your assets and ensures your wishes are followed after you're gone.
Exactly. And that leads us to the second point. Consider using a trust. It can be a great tool to manage your properties and avoid probate, which can be a lengthy process.
Yes. And don't forget about minimizing taxes. Understanding how to structure your estate can save your heirs a lot of money in the long run.
And planning for incapacity is another big one. You never know what the future holds, so having a plan in case you can't make decisions yourself is crucial. It gives you peace of mind.
Right. And finally, communication with your family is key. Make sure everyone understands your plans and wishes. It can prevent a lot of confusion and potential conflicts down the line.
Well said, Sarah. Remember, building wealth through real estate isn't just about buying properties. It's also about protecting what you've worked hard for. It's like creating a legacy.
Exactly. And if you found value in our discussion today, we'd love for you to like this episode, subscribe to our channel, and share your biggest takeaway or any questions you have in the comments.
Oh, and don't forget to share this with someone over 40 who's looking to dive into property investment. It could really help them out.
Next time, we'll be tackling common rookie mistakes and how to avoid them. So if you're just starting out, you won't want to miss it.
Yeah, lots of valuable insights coming your way. Thanks for joining us today.
We really appreciate you spending this time with us. Until next time, take care and keep building that wealth.